This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts, and always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now is Brian Levitt, Global Market Strategist over at Invesco. Brian, I was thinking back to a conversation we had several months ago, and you referred to yourself as a FOMO guy, someone who wanted to buy these tech names when everyone else was calling them just a bubble and a rally that wouldn't sustain itself. Brian, where are you now on that call, given that a lot of people are starting to say, okay, it's a bull market, we might have to live with it, but perhaps we can look elsewhere. Are you looking elsewhere?
Yeah, I think you start to look elsewhere at these, and that's actually healthy. The market is broadening. It's moving into other more value-oriented parts of the market, the cyclical names, smaller caps. So it's not just the very narrow market that you saw, call it March, April, May. You're actually getting a sign from markets that this is healthier and there's more participants. And so far, the earnings for the value-oriented companies have been quite good.
Brian, are things getting less bad, or is the outlook for earnings actually improving?
I think that things are moderating. I mean, that's what you would expect in this part of the cycle. But I think what a lot of investors missed is that the market priced it last year. I mean, 11 months ago, we were down 9%. So in a month, or 13 months ago, I should say. So that was a market that had already assessed what was likely to be a weak economic environment because of all of the tightening. And yet the economy's been more resilient than many expect. I think where people worry a bit is the valuations on the broad market, but that is in a handful of names. And you start to think about this broadening out. The names that have not been bid up are starting to participate more again, which is healthy.
You got to participate, Brian Levitt. But I would suggest what you've got to do is extend your timeline. Where's the new Levitt terminal value? I mean, it used to be 7 years, 5 years. But if I'm going to buy Apple here or all these other fancy stocks, do I have to extend out my terminal value to justify acquisition of those shares now?
Well, some of those names are trading at quite elevated valuations. So you want to be a little bit cautious in the near term. But yeah, I mean, if you're thinking about the structural themes that these companies are taking advantage of, those are long-term stories. So you think about the AI trade, you get a bit of euphoria around that AI trade. I mean, we saw that in the late 90s too with some names around the internet. But if you pick the right names over the multi-year period, you did quite well. It's about avoiding the euphoria and looking at the true fundamentals.
Are you tilting, it's a dangerous question for Invesco, are you tilting active management or passive management at this time?
I think it's both. But in an environment where you're seeing a broadening out, you should see more opportunity in active management. And what you would expect as you move into the next phase. So when we think about a new market cycle, a recovery phase of a cycle, that's when smaller caps do really well. That's when international does really well. And in a lot of those places, that's where investors can really take advantage of active. I also see a lot of money going into money markets. We've all seen that. And, personally, I think yields start to come down over time. So there is reinvestment risk there. And I would advise investors to look further out in duration or to look further out in things like munis or corporate bonds, where, of course, active management can serve you quite well.
Basically, don't fight the momentum. You said, we make hay while the sun shines. And we heard from Peter Scheer over the weekend, don't fight consensus in December and August. And that seems to be where we are. When does momentum stop working?
I think you'll see when all of this tightening starts to find its way into the economy, you'll see the economy roll over a bit. Whether we're going to call it a recession or just a slowdown remains to be seen. But markets go through these phases, and right now this is a market that is feeling like a recovery trade. It's probably not the recovery trade. It's not the beginning of the next cycle. So you'll probably give back some of this in early 2024 as the economy starts to roll over. But what that means is the Fed pivots. And when the Fed pivots, that's when the new cycle emerges. So this is still a recovery trade here. We're likely to see, a pullback in early 2024 with the economy. But as soon as the Fed is, shifts stance, typically over the next couple of years, if not more, you tend to do quite well in markets.
So then how do you borrow the rally and not buy it, not buy to own for the long term if you're looking to avoid some of that give back in the beginning of next year?
Well, that was part of what I was talking with Jonathan about with the FOMO story. It's, I don't know how tactical investors want to be. I mean, if we have tactical strategies that'll rotate based on where you are in the regime. But if you're looking out even from here over the next few years, you should be invested in risk assets. If I use 1980-81 as an example, and I think I've said it on this show before, that you got a nice rally once inflation had peaked in March of 80. The market did roll over with the recession. You never went through the bottom. And again, if you had invested when inflation had peaked in 80 or when the Fed was done tightening at the end of 80, you were very happy in 82, 83, 84, and beyond. So, focus on to me, it's focus on what tends to move markets most. End of inflation, end of tightening tends to be very good for risk assets.
Brian, first in, first out. The rate hiking cycle in EM started months and months, maybe 8-9 months before the tightening cycle started in DM. We saw the rate cut over in Chile on Friday. I think Brazil's going to follow on Wednesday. Others will follow later this year. We've got an easing posture, I'll call it, coming out of China. Brian, what are the opportunities in emerging markets at the moment?
Yeah, I mean, look, you want to lean into where policymakers are providing support to the economy. And this is a very interesting environment. Investors didn't love EM for the prior decade because EM struggled to come out of the global financial crisis. To your point, EM leads out, more accommodative. And even what you saw in the developed world, what you saw specifically with Japan on Friday, I mean, this is a very different environment where the Fed could be contemplating easing by next year, and the major developed market central banks are still tightening, which tends to portend a weaker dollar versus our major trading partners, which we haven't seen in a long time. And that starts to unlock some of that value that exists outside the United States. And, investors haven't been there. They've avoided it, but it's a better backdrop for international investing than we've seen in a while because, quite frankly, anytime international participated in the last cycle, either the U.S. freezed rates or started a trade war or we got a pandemic, which ended up abruptly ending any type of participation from international markets.
We've been burnt a few times. Brian, it's good to catch up as always and great call for the year so far. Brian Levitt there of Invesco on this equity market. Thank you, sir.
Right now, on what we've done under surveillance, looking here particularly at the Pacific Rim, Carl Weinberg joins us. He's chief economist at High Frequency Economics, but far more than that, is steeped in financial crisis on an international basis. And his notes on China and Japan have been absolutely definitive. Carl Weinberg, why hasn't the yen moved abruptly off of the verbiage and action of the Bank of Japan?
Hi, good morning, Tom. Good morning, John. Good morning, Lisa. The currency isn't going to move on a dime. They only moved on Friday. And this change in policy sets off different forces in the economy. It's not just about interest rate differentials. But if you're an investor in Japan and you're looking to deploy marginal funds, you're looking at almost an assured loss on long-term JGBs right now. And if you need to have long-term assets to offset long-term liabilities, you have to look abroad. So to a certain extent, this tightening of monetary conditions or the allowance of bond yields to rise, whatever you want to call it, drives money abroad and makes the yen cheaper, which is not what your traditional interest rate theory says it ought to do in the terms of the currency. But I think we have to expect a really mixed pattern for the yen moving forward from here.
What's your scope and scale on yen move? I mean, I know you're not in the business of FX analysis, but are you looking 150 yen or 132 yen?
Well, I'm not going to take a long-term position on that because I still don't know what the Bank of Japan is up to entirely. I mean, we saw this widening of the band. Was this a technical adjustment just to allow more trading both ways in the bond market and to improve trading conditions for people who have to be in the market? Or was it the first step in an actual tightening of monetary conditions? It's not at all clear. As Lisa pointed out, we did the calculations that show that if we had the bond market fully adjust to the increase in the band, that the hit to portfolios economy-wide would be about 4.5% of GDP. That was our math. And right now we have a huge profit on the Nikkei that if we were to call the end of the fiscal year today and all that bond yield headroom were used, we'd see kind of a wash between gains on equities and losses on bonds. That's a one-shot deal, and I think that Ueda-san is hoping to take advantage of that, hoping that the stock market will continue its rally and offset losses on the bond market and give him this little step toward normalization. But if that's it, if it's half a percentage point and that's it, then there's no impact on the yen whatsoever beyond the next couple of weeks, and there's no basis to look for a major move.
We were also talking about China and how much willingness there will be by the People's Bank of China and just in general from authorities to support an economy that's flirting with deflation, outright deflation. Do you think that they can come in with something that can avoid more protracted deflation over a sustained period of time?
Well, good morning, Lisa. You know, China's inflation has been nothing much to talk about for a long time. We've been talking about sub 2% inflation, except in times when pork prices have been stalling. So we're at the low end of a distribution, but we're not nearly in a deflationary range. The signs of deflation are not there in China in particular. The monetary aggregates are still growing, although not as fast as they'd like them to grow, and wages are still going up. So I'm not particularly scared about deflation in China. What concerns me more is that of a deep recession in China that might have impacts on the stability of the regime, on the stability and constancy of economic policy, and that's where I think the big risks are. China, unlike the Western economies, doesn't respond to interest rate cuts, to the normal kinds of consumer spending or depressing policies that we see in the Western world, because most of their growth is driven by investment and not by consumer spending. And most of that investment is planned by the state. The problem with their growth engine is that they've run out of really lucrative investment projects, and that's causing their growth rate to slow down on a secular basis. And that's what they have to try to offset by switching the source of growth from investment to consumption. And that requires a careful mix of policies.
Just quickly, Carl, how likely do you think it is that there is some sort of deeper recession within China?
Well, I think that a recession is probably not the right word. It would be what we would call a growth recession, where growth doesn't occur fast enough to absorb people who still want to come from the farms into the city and to generate the increases in income that people want to see. I think that's the scenario we're looking at in China, subpar growth. So we'll see growth this year of maybe 1 or 2 or 3% is our forecast, about 3%, but that's way short of what they want, which is in the 5 to 6% range, and that's a problem for policymakers.
Carl, thank you for your insight. It's always valuable. Carl Weinberg there of High Frequency Economics on China and what's developing at the moment.
Right now, we will go to the red bars. They're in a New York Times poll today, which is front and center as we stagger into August of 2023. It is in August of a Republican debate. Wendy Schiller joins us now, Director of Taubman Center for American Policy at Brown University. She's familiar with the electoral process. Wendy, have you ever seen anything like this? We got a guy with various legal challenges completely dominating a party, 54% Trump, the governor of Florida, 17%, and everybody's barely a heartbeat as well. Does Trump own the party?
It looks like he owns the party right now, and he's being treated like the incumbent president. You know, how dare you challenge him? I think, you know, if you're the opposition, the takeaway from this poll is you have to go after Trump directly. I think they've all resisted it, particularly DeSantis. He sort of runs around it, but he's got to go right at Trump. Some of the comments that they had solicited in the poll after their sort of standard answers were, Trump's a fighter, Trump's a fighter. That's exactly what they want to see from the other candidates. Are you willing to do what this guy does? And the other warning sign, I think, for the party as a whole is that seems to be a bunch of Republicans that are willing to throw out the rules. Right. So if Trump loses a few primaries or it's really close and he claims they're rigged, he can undermine the entire Republican Party nomination system. So I think that the comments are really important to look at in this poll.
Long ago and far away, Jimmy Carter, the governor of Georgia, walked down the stairs of an airplane in Rochester, New York, and shook Midge Costanza's hand. And we all said, who is this guy? Who's the Jimmy Carter this time around? Of the 2%, the 3%, Pence, Scott, Haley, Ramaswamy, Christie, who's the Jimmy Carter of the moment?
Right now, I think it's Tim Scott. I think that Tim Scott has a lot of the qualities that would appeal to the base if they could get themselves out of a sort of cult of personality of Trump and, out of the sort of avenging his loss in 2020. I think he has a lot of appeal, particularly among evangelicals or conservative Christian voters in the South, and can peel away, theoretically, some portion of that African-American base, just as George Bush sort of peeled away a considerable portion of Latino base, but also a little bit of the African-American base. And I think that's someone you should pay attention to. I think you, the political observer, should pay attention to. And a Trump-Tim Scott ticket would be a very interesting dilemma, I think, for the Democratic Party.
You said that one of the things that candidates have to do is go straight after the former President Trump. And yet Will Hurd, formerly of Texas representative, came out and actually did that in Iowa, and he was booed off the stage. What makes you think that it will be received by the voters?
Well, the question is who's going to these rallies, who's actually going to vote 6 months from now? And do you set the stage, like Chris Christie's trying to do in some ways, of saying, I can fight just as hard for what you believe in, and I'm willing to take your boos. I'm willing to take anything you throw at me, but I'm going to stay in the race. And I think that's, if it's possible for them to do in terms of financial contributions. The other problem with this poll for DeSantis is that it will scare donors, right? That this guy can't get traction. What do we do? And the Republicans have to be careful about the Senate in 24. The House, this helps, right? Generating Trump fans going out the door for polling is good in gerrymandered districts for the House Republicans. But for the Senate, they lost in 2022, mainly because of Trump-endorsed candidates. The same fate awaits them in 2024. So this is going to send, I think, some shudders through the entire Republican Party.
Today, we're going to get some disclosures from the former President Trump's campaign in terms of the Political Action Committee and how some of the money has been spent. The expectation is that millions, tens of millions of dollars have been spent on legal bills for Trump as well as his associates. Will this be a problem for the donors, or has this been sort of understood that this is sort of the fight that they're trying to get behind as part of the fight that he is launching for president?
Lisa, this is a sort of a watching technical question for people who care about campaign rules. But Trump has made no, bones about soliciting money for him, for his campaign, for his legal defense. It is all about him. It is not about the Republican Party. It is about him. So nobody will be surprised. And the donors, particularly small donors, don't seem to care. They're in it for him. He's their team. They're not defecting from him. The problem is, the majority of voters, or the people who can win an election for you, have defected, particularly independents, but some slice of the Republican Party. And that, for the general election, is really a tremendous problem, facing the Republican Party going to 24. So, the voters in the Republican Party don't care how Trump spends the money. They're giving it to support him.
Can we talk about the voters in the Democratic Party and how they might view the president's handling of his situation with his son at the moment, Wendy? There are plenty of allegations over the last year about his business dealings. What have you heard on that recently?
Well, I think Democrats face an enthusiasm gap. We've seen that. Biden's getting a little bit better. His approval rating going a little bit higher. Things are better than people thought they might be, particularly with the economy. And some of the policies that he enacted are starting to show to voters. So he's got a little bit of momentum. He said flat out he wouldn't pardon his own son. This deal that fell apart, the plea deal, I think in the end, politically, that's an advantage for Joe Biden. I think people were skeptical of that deal, and it could be a liability for him a year from now among Democratic voters who don't get the same deal from prosecutors. So I think in how this plays out for Hunter Biden, if there's any punishment that people view as legitimate, I think that actually helps Joe Biden. Personally, obviously not, but politically, I think it does.
Wendy Schiller of Brown University. Wendy, thank you.
But we need to talk to Doug Kass because he is a conduit to Kate Upton. And the real question here is, does Mrs. Verlander, does she decide that we need to stay in New York for their daughter's well-being and schooling? And Doug Kass, is Kate Upton the one that will decide whether Mr. Verlander goes from the Mets to the dreaded New York Yankees?
We do need some help. Speaking of pitchers these days, I feel like Luis Severino. He had an outstanding year in 2022. I think his win-loss record was 7-3 at an earned run average of 3.10. This year he's 2-5 with an ERA of 7.50. I feel that way being bearish on the markets.
What I see here, Doug, and you and I have had such a joy talking the history of the game, I find it fascinating how the end of July is maybe the tension of what we felt the first week of September was not too long ago. Do you think the new expanded wild card has been good for the sport?
Oh, gosh, I don't know. It seems it's when all the trades occur at the end of July, because there's finally a resolution of where you stand. Stevie Cohen's a very good example. His move last week with his pitcher.
I mean, it's going to be interesting to see. Just one more question on baseball, Doug Kass. What do the Yankees do? I mean, I don't get it. I mean,
No, I have to talk both about the Yankees and being wrong-footed on the market.
Let's make this easier. Does the GM go? Mr. Cashman, does the GM go?
I said to you last year I thought he should go.
Okay.
I was pals with his dad, who passed away, unfortunately. And Brian's a good man, but maybe it's time for a change.
Yeah. Your agent says, okay, it's time now to talk the market. Doug Kass, you've been wrong-footed on the market, as you put it. We've all been there. We all have a humility of how hard this is. How do you go about identifying that this is perhaps a true bull market?
Well, as I said, there's nothing more humbling than being on the wrong side of a trending market, especially if one approaches the investment business as I do, with intensity, as I do with the New York Yankees. So I'm 0 for 2 this year with a pretty high ERA, and that's been the case for the last couple of months. Look, 2 quotes come to mind. The first one, I think, was from Emerson. He said, "In life, our greatest glory is not in never failing, but in rising up every time we fail." I did a terrible job I did a good job in expecting a strong first half, unlike the consensus, and we were positioned for that, but I did not expect the rally of the last 3 months on top of the 10% rally ahead of it. I think there's another quote Howard Marks made in Taking the Temperature of the Market, one of his great oak tree commentaries last month. He said, "Remember that in extreme times, the secret to making money lies in being contrary, not being a conformist." And to my credit, we think that risk control is an essential part of managing money, especially when one is as wrong-footed as I have been. Indeed, in the remarkable advance of the last couple of months, we have been net short, but we didn't lose net money in the last couple of months.
Give me a number here. I mean, I don't like to talk numbers with people a lot, but when you say you've been pounded the market, I would suggest with your risk management, it's not as painful as some people. Are you down like single digits, or is it double-digit agony?
We're up for the year. And as we were last year when everyone was suffering. And as I said, in the rally of the last 3 months, we're even. So we're not even on the year. We're even during that period, which is a good example of the importance, which a lot of people don't discuss, even you guys sometimes, is risk control. I know Allison Schrager did a wonderful conversation in the prior segment about controlling reward versus risk. And a lot more discussion should be made about that.
So with hindsight, Doug, what do you think you and your team got wrong over the last 3 months?
I think what happened is I underestimated the animal spirits and the fear of missing out in a market that has changed structurally and now is dominated by products and quantitative products and strategies that utilize volatility more than ever before, and price momentum. And these strategies know everything about price and nothing about value. And it's in periods like this, I think that's what bulls like myself and Mike Wilson misunderstood.
What have you taken away, if anything, from this earnings period that we're kind of just smack in the middle of right here?
Look, I see basically earnings as they always are in 70% of the cases, slightly better than guidance, which is, by design by investor relations departments, and also they're slightly higher than revised lower of 6 months ago earnings expectations. But we see the emergence of a number of concerns, not the least of which is sluggish growth and prickly inflation, what I call slugflation, as opposed to stagflation. And you're seeing it now in agricultural commodities, the CRB food stock index at a 52-week high. Look at the price of eggs, of bacon, of urea, of ammonium, and obviously, of course, oil, which is now up, I believe, has its first 5-week win streak in a year and a half or 2 years, and now is above its 50-week moving average. These are all. I look at orange juice, which we drink. You drink Tang, phony orange juice. But normal people, Tom, drink orange juice, and it's up 24% in the month of July. And people, look, the bond market has gotten the clue. The 10-year is up 12 bips in the last week, up another 3 or 4 bips today, and they figured it out. But the market hasn't because of, in my view, market structure, animal spirits, and FOMO.
I think that's.
And the other thing is that what we've also realized is that the U.S. economy has grown far less interest rate sensitive than the consensus or our monetary policy authorities suspect. So, fundamental to my and the cornerstone of my bearish view is that we have higher for longer policy, and our rates are going to remain high, and we have as a result a paper-thin equity risk premium, which portends valuation risk, reduces the margin of safety, expands the downside risk for stocks relative to the upside reward, and extends the advantage of credit over equity.
Yeah, very quickly here, Doug. What everyone knows is there's a massive overweight on tech. How does that end?
Well, it ends badly. I facetiously said in a column I wrote on Real Money Pro that I sent to you that AI is for now an elegant parlor trick, with few accumulating near-term revenue benefits and a lot of increased costs.
Yeah.
We will recall the internet created the dot-com boom, but that didn't keep the NASDAQ going down 83% in the next 3 years, beginning in late 2000. So I think that the greatest overvaluation in the market is technology. You have to remember we were buying Amazon, Alphabet, Facebook at the end of last year. Remember the tax selling, how these stocks were being thrown out, and no one wanted them. This is the only business where people are confident in view and can be terribly wrong and come back and are confident in view again. I mean, the bulls today are much like the bulls at the end of 2020. 2021, who were bearish in October 2022.
We got to go. It reminds you of the Yankees in Tampa in February. Doug Kass, thank you so much. Greatly appreciate that. That was Seabreeze Partners. Right now, and this is a joy after what we saw in Belgium, to bring in Zach Brown. He's the Chief Executive Officer of McLaren Racing. And to give you an idea of the breadth, the scope, the scale of his history with racing, he actually was in the cars doing it at a very young age. And he's someone that also has a great amount of Americana, including a precious letter from George Washington to someone arguing about the travesty of Benedict Arnold. This is a Renaissance man, John, running things at the August. You told me McLaren was special.
It's very special. Yeah. And it's a special opportunity to catch up with Zak Brown of McLaren Racing. Zak, wonderful to catch up with you, sir. A difficult weekend compared to the success in Hungary and at Silverstone in the UK as well. Zak, can you catch these Red Bulls this year? Can you get a win?
Well, we're trying. We need them to blink. But, there's a lot of racing left to go. We're getting closer. Unfortunately, no one's close enough yet. But I would think a win is possible in the second half of the season. It's certainly our goal.
What is it about the setup of the car, the developments that you've made over the last several races, Zak, where you think you've made progress? And what kind of races on the calendar do you think we can see that a little bit more?
Aerodynamics, it's very much an aerodynamics game. Of course, you have to have two great drivers, which we have, and you have to have great pit stops and reliability, but it is an aero game, and that is where we've made our biggest gains. We started that in Austria. I think some of the quicker tracks, so I would think Austin, Japan, we should be strong. Abu Dhabi, we should be strong. It's the slow corners we don't like, but who likes going slow anyways? So, but that's where we need to improve. And we've got some more developments coming, but so does everyone in Formula One. So it is definitely a development race.
Zak, I watched every minute of Belgium, and somewhere in the vicinity of lap 31 or 33, there was Zak Brown talking to a 22-year-old kid quietly who had gone out of the race early as well. Oscar Piastri is 22. At 14, he was basically a professional. That's all these kids do is drive, drive, drive. What were you saying to Oscar Piastri at lap 33 there after he bombed out of the Belgium race?
Yeah, I told him a couple things. One, don't worry about it. He had such a great Saturday. He's having a great season. So these guys feel like they not only let themselves down, but the team down. And so they need to know we're all in this together. We win together, we lose together. And then also we had a pretty difficult race with our aero setup. So at that particular moment, Lando was going backwards until we kind of strategically got him in a better place. So I also told him he probably wasn't missing having too much fun at the moment, just being a little bit lighthearted. And, these things happen. He's done a fantastic job all year.
Explain to our American audience, including a dummy like me, what did Bruce McLaren give you? What does the McLaren name mean to Jon Ferro and auto racing?
He was a legend. He was all about innovation. He was a driver. He was a designer. So, we're very proud to wear the papaya colors, which was Bruce's colors back in the day. And that was actually done so he could have more standout on television back in the black and white days. And so he's an inspiration to all of us. And he was a racer. He was an innovator. He was a designer. And, of course, a team owner. So we're the second most successful team in the history of Formula One, and something that we're very, very proud of. And we were also the only team to have won what's called the Triple Crown, which is the 24 Hours of Le Mans and the Indy 500, and, of course, the Monaco Grand Prix. And it's something that we can hope to do again in the future.
Zak, as you try to plow further into the U.S., this is something that Formula One has tried to do, is I'm learning, and I'm one of the people who are becoming the adopters here. Where is the distinction, the overlap between Formula One and NASCAR? How competitive is that at a time when NASCAR already has such a cult following in the U.S., and Formula One has a very different type of energy coming from Europe?
Yeah, I think they're complementary. They're different. They're probably have almost the same similarities between baseball and basketball because they're radically different as far as the type of racing. So a little bit of a different demographic and psychographic. Obviously, Formula One is very global, where NASCAR's a domestic sport. But I think all motorsports help each other. So I think there's room for both, including IndyCar, which is much more like Formula One. It's just awesome to see how big Formula One has got in America as quickly as it has. And I think Netflix obviously has a lot to do with that, as does the Austin Grand Prix. Miami Grand Prix and the soon-to-come Vegas Grand Prix, which is going to be off the charts.
As a lot of purists probably feel that the Netflix series perhaps inaccurately reflects some of the drama or the lack thereof, as Max Verstappen, as John was pointing out, has noted, as an American who has been in a sport that really has been dominated by European presence, how does the sport have to change to really become as popular in the U.S.?
Well, I think it is changing, and a lot of credit to Liberty, who acquired the sport, 5-6 years ago. I think Netflix is a great example. That would have probably not happened with previous ownership, because the industry, the sport, would not have wanted the cameras on the inside of the sport. It was kind of wasn't an inclusive sport, and I think now we're very digitally savvy. We've embraced the fan. We're all about the fan, and things like Netflix, where we're showing people about our great sport. And I've seen some of those comments, which are a little disappointing, because I think they're a bit inaccurate in the sense of, we're capturing our great sport. When Netflix puts together the content, they'll sometimes pick and pull because they're trying to illustrate a point. So we, as the racers, will see, for instance, that was a clip of our pit crew from Monaco, but they're showing us in Italy. But it kind of doesn't change the narrative. So I think we're a little bit too close to it. And because Formula One's all about the details, we get a little bit wound up when the detail's a little bit inaccurate.
Zach, tell me how the commercial agreements have developed over the last couple of years. Let's just say, for example, we wanted to put Bloomberg surveillance on the side of Lando's car. Let's just say. What's the cost of that now compared to what it was several years ago, Zach? How much has the price of that increased?
It's probably gone up twofold in 5 years. And I think what's great, though, is the exposure is gone up fourfold. It's all about value for money, but the demand, if we look at our partners, right? Google, Cisco, Dell, Goldman Sachs, these companies were not considering Formula One 5 years ago, and now you've got the world's greatest companies joining those that were already there. So it's been an unbelievably commercial success.
Zach, real quickly, and by the way, John and I think we can piece together $5,000 to get Bloomberg surveillance on the side of the car. You guys are always tweaking the cars. Now, you've got a summer break like Ferro has a summer break. John's taken off all of August into September. You go from Belgium to Netherlands. Is your car going to be tweaked and different for Netherlands, or do you actually take a real European holiday?
No, well, a bit of both, but everything's about advanced planning. So we will have new bits, if you'd like, on our car in Holland, but those have already been developed. The shutdown is for the technical team, is mandatory. We can't even send an email. So I'm going to go to America and spend some time with our IndyCar team, because you can't keep me away from a racetrack. But no, it is a very genuine, you cannot touch the race car for 2 weeks. You can't even communicate about the race car, but that's all planned in. So our developments are already ready for Holland.
I'm having that written into my contract.
I was going to say, is everybody?
Zach, I love it.
Brad, Qantas, did you just hear that?
Zach Brown of McLaren Racing. Zach, thank you, sir. Appreciate it, and good luck for the rest of the season.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.